I want to thank everybody for joining us for our fourth Yahoo Finance Premium webinar, Trading Election Year Odds and Managing Risk Amid Rising Uncertainty. I'm Jared Blickery, and what a bout of uncertainty we've had recently. By October 6th, yesterday, we'd had not one but two October surprises. So we're going to be covering the following. What do these latest events mean for the markets? What happens with a contested election? What does a blue wave mean for your portfolio? And to help us, we're soon going to be joined by Ryan Detrick, Chief Market Strategist and Senior VP at LPL Financial. He is a Chartered Market Technician, CMT. So we're going to be covering lots of technicals, lots of fundamentals, lots of macro policy stuff, portfolio management, the Fed, and of course, lots and lots of stats. We're also going to be demonstrating some of the features of our Yahoo Finance Premium service. This is how you can use it to find stocks that show signs of promising returns, and also use it to analyze your portfolio and fine-tune it. And now just a few notes on our webinar software. You're going to be able to interact with us in real time. That's because we're running BlueJeans secure video conferencing platform, now part of Verizon. And we're going to be running polls for the next 45 minutes, which you will see at the right-hand tab of your screen. You can post questions at any time using that same tab at the right of your screen. And you can use your real name or just post anonymously. So also, this is how you control the size of the various windows here. At the bottom left of your screen, you're going to see little sliders, and that's how you make the presenting screen bigger, smaller, as well as video boxes for me and Ryan. So let's get started, and I want to start out with a poll. Again, those are going to be on the right-hand side of your screen. And the first one is, the second most volatile month for stocks since 1990 is it February, May, August, September, October, November, or December? We're going to have the results in a few minutes, so just make those selections now. And I'm going to bring in Ryan Detrick. Ryan, thank you for joining us here. Great to have you. And I just wanted to begin, I think you're muted there, Ryan. I just want to begin with market analysis because we have had some crazy price action over the last few days. Ryan, are you able to hear us?
Yes, I guess you guys muted me and I didn't realize I had to unmute myself. So chalk that up for the first mistake, but that's the only mistake I'm going to make in 45 minutes. So yes, thank you for having me, Jared.
Everybody,
appreciate it.
As I like to say, everybody gets one of those a month. Not your fault anyway. But I want to take a look, and I'm going to share my screen here. We're going to take a look at the Qs. This is the ETF that tracks the NASDAQ 100. And we saw a really big reversal yesterday. Of course, we're up again today. And just looking at this chart here, this is a daily candlestick chart. We got some moving averages, the 20, the 50, the 200, goes back to March. So we can see the lows down here. Been quite a run, but we've been in this consolidation for the last, 6 weeks now. What are you making of this latest price action, Ryan?
Well, I mean, the Qs, Jared, clearly they're the leader of 2020. We know that, right? And just, before this recent sell-off that we had, the Qs were more than 30% above that 200-day moving average. A geeky way of saying that's an extremely stretched market. The most it's ever been stretched since when? Since 2000. So you hear 2000, you start thinking, oh my goodness, bad stuff coming around the corner potentially. But we don't think that's the case because, again, you've got the Qs now just consolidating, catching its breath, and we're going to talk about other parts of the market. But I like looking at semiconductors. I mean, semiconductors are just a big part of technology in general. Relative strength versus the S&P, semiconductors are breaking out. Earnings have been strong in technology in general. Now the Qs, it's not all technology, but believe me, it's a lot of technology. So overall, we still say stick with who brought us to the dance, right? Stick with who brought us to the party, and that is some of the big cap names, some of the tech names. And let's not forget, we're in a low growth, low inflation, low rates world. That's probably not going to change next 12 to 18 months in our opinion. And historically speaking, that is a tailwind for what? For growth, because investors reach for growth. So you've got these tailwinds in our view. They just got ahead of themselves. I mean, that's the truth. They got ahead of themselves because of the pandemic. But that's a group, we still like, and we still think next 12 to 18 months will probably do pretty well for investors, really.
Yeah, we just got to get through these next 4 weeks. But I want to get to some seasonality here because that's a big part of the reason why a lot of people are here. Let's pull up election year seasonality, and we're going to take a question from the audience here. This is from Bryant, and he's asking, what does history say about the market returns from October to December in election years and the returns in Q1 the following years? So we have this chart out that you have prepared. any people might remember from Twitter because I've seen it making the rounds here. Can you set it up for us?
Yeah, I mean, so there's different ways to break it down. In this one, I broke it down by election year and if the president's up for re-election. The bottom line here is ahead of the election and during an election year, October, scary month of October, is actually the worst month of the year on average. Now, you can see on the chart there, when you're up for re-election, maybe there's a little bit more sideways consolidation. But still, it's kind of the way it works out. It makes sense. People are a little skittish ahead of the election. There's some reasons maybe to sell, and we wouldn't be shocked at all if that were the case. Once again, we've had the sell off, I guess, in September. Now more volatility, and it's amazing how much we bounced back today versus what just happened yesterday, 24 hours ago. But you talk about the fourth. I know we're going to get some other slides coming up, but the fourth quarter historically is a pretty good quarter. It's pretty good during an election year. Also, the reality of the fact is the market tends to be weak until that election, and then whoever wins, right, Republican, Democrat, whatever usually happens, once that the market hates uncertainty. We've all heard that time and time again. But what we've been telling our LPL advisors is use any weakness as an opportunity to potentially have that end of year rally that you tend to see more often than not during an election year. And that's what we're kind of expecting to play out. Once again, kind of because of the underlying fundamentals of this economy. They're not great, but they're improving, and earnings are looking pretty good next year. So those are all big positives, we think, to continue to be a buyer of dips in this current market environment.
Yeah, you got to imagine a lot of those comps are going to be pretty interesting over the following 4 quarters at least. But
yes.
we brought up another slide here, and this kind of builds on what you were saying. In year 4, we usually have gains in all 4 quarters. So, what is this? How does this fit with your other work?
I guess we didn't have a gain the first quarter this year, though, did we? We were down 20%, then up 20% in the second quarter, and another big gain in the third quarter. But what we like to point out is the average. And what's the old saying? There's no such thing as average, really, if you think about it. There's the statistician who put his head in a bucket of ice and his feet in the oven. They said, "How do you feel?" He goes, "Well, on average, I feel pretty good, right?" I mean, still, I'm aware there's no such thing as average, but still. The average fourth quarter gains about 4%. Now, you can see on the screen there, when you break it down by presidential cycle, the fourth year of the presidential cycle, S&P gains about 2%. You'd say, oh, well, that's kind of weaker than normal. Maybe there's some truth to that, but it's actually higher 82% of the time. Just a couple of big drops kind of skew things. So bigger picture, as uncertain as all elections usually are, and this year specifically, this one, the fourth quarter of an election year is higher 82% of the time, which, as you see, is one of the more likely quarters out of the 4-year cycle, out of 16 quarters, to actually be higher. And we think that probably plays out again here in 2020.
Yeah, and we've seen, just 4 years ago, we had that meteoric rise after President Trump was elected. And that's after S&P futures crashed, limit down the night of the election. Everybody seemed to be banking on a different outcome or result. But I want to move on to our poll results. So the second most volatile month for stocks since 1990 is the biggest winner here is October, followed by September. In actuality, it's November. And can we put up the October volatility slide that we have here, guys? And this is going to show the average VIX performance since inception in 1990 through 2019. And we can see September, October, November, all elevated. So pretty close there, guys. And Ryan, what is this representing to you? Because we're not just talking about election years here. We're talking about this pocket of volatility, September, October, November. How do you interpret this?
Yeah, I mean, you had spectacular crashes in October. We all know 29. We all know 87, 2008. October 2011 was one of the greatest monthly gains we've ever seen. So October, it gets a bad rap in my view. If you look at average performance, it's about the 7th best month on average for stocks. So it's not great, but it's not this terrible month either, but it is volatile. You've got the VIX there, that shows high VIX usually. You also have more 1% moves either up or down in the month of October than any other month. And believe me, you could ask 10 people why October. I know a lot of hedge funds and believe me, there was no hedge funds back in the crash of 29. Let's get that clear. But now you've got a lot of hedge funds at fiscal year ends, the end of September. The fourth quarter is normally strong, so maybe some skittishness, and you get to the feel-good time of November and December. It's tough to pinpoint one reason why. The reality, though, as investors, and we've been telling our more than 17,000 LPL advisors, we're saying, listen, it is what it is. October can be volatile. you get your October surprise, and we've got a couple of them so far. And let's hope maybe the next October surprise is maybe positive news on a vaccine or major, more therapeutic breakthroughs. That'd be a nice October surprise, wouldn't it? But still, it's just kind of one of those things that you don't want to ignore. I mean, Mark Twain, said history doesn't repeat, but it rhymes. Well, a volatile October is what we tend to see more often than not, and that's something to be aware of as investors.
Yeah, and I think that came from Pudd'nhead Wilson. All right, we're gonna go to another poll
he steals
here.
all the good quotes. I say Mark Twain. I think he gets credit for all of them. He and some of the famous generals. They didn't really say him, but I give him credit.
Sounds good. Here is our second poll. How long have you been trading stocks? 1 year or less, 1 to 3 years, 3 to 10 years, 10 years or more. We ask this at every webinar, just trying to gauge the audience in the room and what your experience level is with stocks. So now we're going to take another question here. This one's from Hank. What industry or industries have better value before or after the election? And I'm just going to start with this one. And the way I see it is, September was a month of, we had that big sell-off and then consolidation. And I think that was simply repricing election risks that really haven't been priced in up until then. And that's one of the things we've seen over the last 4 years, I would say. What the first time I really noticed this was Brexit, how fast things get repriced in the market. We're coming off the fastest bear market in history. We've at various times, this has been the fastest bull market in history. And what we're seeing now is possible expansion of the yield curve. And so that would be kind of the blue wave bet that we have Democrats in Congress, both houses, as well as the president. And if that's a play, you're going to have an expanding yield curve. You're going to bet on infrastructure. So that's materials, industrials. And we saw those sectors. We've seen them come into rotation in fits and starts throughout this entire rally, but I would say more so recently. And Ryan, what are your thoughts on this?
Oh, we agree. Not to mention small caps. I mean, small caps are another kind of get the economy going, better times ahead potentially, and they've started to show some leadership. But I kind of mentioned earlier, we like technology. That's where a lot of the growth is coming from. We like communication services. But I mean, why do you have to just pick one or two sectors, right? We're saying go do a barbell approach. Stick with some of those leaders, communication or, technology. And then over here, you've got those cyclicals that you said. We like industrials. We like materials. We don't like banks as much. I know if the yield curve goes up, that's supposed to help banks and financials. But still, we're a little lukewarm on that group. So those are kind of two barbelled approach where if the economy is slow and doesn't move a lot, we know the playbook. That's going to help technology and big caps over here. But if things keep opening up and we get a vaccine and the economy keeps surprising to the upside, which honestly, I know the employment data has been weak. Most of the other economic data, though, has surprised to the upside. It makes sense, kind of in our view, to kind of have that barbelled approach and benefit both ways potentially.
Yeah, good commentary there. While you were talking, I was flipping through some charts, and I just want to kind of explain how these fit into the macro picture here. We're looking at the 10-year Treasury yield. And I think what's most obvious here is we've just been in this incredible consolidation. And I'm going to try and draw a straight line here, but you can just see it's been in a box. Yes, we went above in a few places and probably below as well, but it didn't last long. And that means we've had this run up in Treasury yields over the last 3-4 sessions, and it could very well reverse at these levels. And we've seen them reverse before right around here. So the rotation that we've seen in the last few weeks in fits and starts around these cyclicals, that could continue. But if yields drop back down, and that's going to favor those big growth names, the mega caps like Apple, Amazon, Tesla. You throw that in as a FANG stock now too. Those stocks did very well and were the go-to choice when interest rates were dropping. And that's because in a growth, and you want growth stocks when you have a low interest environment. It gets into there is no alternative and a bunch of other things. But in general, when you have dropping in interest rates and a contracting yield curve, you're going to see defensive names like utilities outperform because they're interest rate proxies, and then those big cap growth names. And on the way up, that's when you see the rotation into industrials. And I think that's, and some other, maybe some value plays, pick and choose here. But I think that's what we're seeing is the anticipation that we could have an expanding yield curve. And we're preparing for that now, but it's not going to be a straight line. Even if the index tends to go up from the lower left to the upper right, in the individual sectors, there's going to be rotation. It's not going to be easy. All right. let's do this. Let's read the results of the last poll. So 35% of you have 1 year or less experience trading, 30% have 1 to 3 years, and 22% have 3 to 10 years, and 13% have 10 years or more. So the most popular answer, 1 to 3 years. All right, and we do have another poll, and I think we might have given away the answer, but that's fine. This is poll number 3. The historically best quarter for stocks in any given year is it the first quarter, second quarter, third quarter, or fourth quarter? And we're going to be taking that poll down in a couple of minutes here. Ryan, I want to bring you back in and just talk about talk about the current bull market, because you have, and guys, can you pull up big third quarter? We have a slide that shows when we have big gains in the third quarter, they oftentimes translate to the fourth quarter. How does this fit in with the discussion we were having previously with the seasonality?
Yeah, well, first off, on the recent poll, I did give it away, so sorry about that. But this is, I guess we'll know how closely everyone's paying attention, because I did give away the answer on what quarter is the best one. So we'll see. But yeah, I mean, historically, the third quarter is not that great. Okay, that is usually what we see. It's usually a weak third quarter. That we had anything but that this year in 2020, where stocks gained up over 8%. The S&P gained up over 8% in the normally weak-ish third quarter. We got to thinking, we're like, what does that mean? Is that giving any clue, any sign what might happen the fourth quarter, which again is normally pretty good? Sure enough, as you see on the screen, every single time we've had stocks in the third quarter up 7.5%. The fourth quarter has been higher, and actually by a pretty wide margin a lot of times. So I think it's just the market's way of saying, something's going on, and we don't necessarily know what, but something's going on under the surface that this normally weak time does well. You mentioned yields. I want to go on that for a second, because you had a good discussion on yields. Remember back on, I guess it was the last new high was January 21st, I think, February 21st. S&P made a new all-time high, the last new all-time high until the 34% correction. The bond market was freaking out most of February, meaning freaking out as in yields were dropping significantly. Everybody, all the stock guys were looking around like, what's the bond market worried about? Stocks are making new highs. Everything's great. Well, the bond market was worried. But now what you see with the 10-year yield, it's not breaking down again. In fact, it's kind of starting to break out. So the stock guys get a little worried here. Oh, too far, too fast. There's concerns. Now the bond guys aren't so worried. And to us, that's a really good sign. Some people say bond guys are the smartest guys in the room. I kind of believe that to a degree. And they're not as worried now, right? Credit spreads, I don't want to get too geeky, but credit spreads have really come down. Some of the most hit industries have been devastated by this thing. Their credit spreads have come down. So there's some confidence coming in the fixed income world on the economy. And that's something I wouldn't necessarily want to bet against. So the bond guys are right back when we had the big worry. Now, maybe if the economy's better, maybe the bond guys will be right once again here.
Yeah, that's a great explanation, Ryan, and it kind of fits in. I just want to take a couple more questions about bonds since we're on the topic. And one here is 10-year Treasury yields. You mentioned 10-year Treasury yields are rising. What is your view for the next 6 months to a year? And one other, how can one justify investing in bonds when the interest rates are so low and can only go up? Well, I'm going to take that first. I'm going to say they can go down again. We could have some deflationary shock. Any number of things could happen in the coming quarters. Not expecting another full lockdown, but some of the ancillary knock-on effects of what happened before the economic shutdown, those might propagate through the system. Commercial real estate, the Fed's been looking at that. You also take a look at some of the other economic indicators. Jobs, we're just seeing huge layoffs, potentially in the airlines. Disney, 20,000, something like that. So my view over the next 6 months is interest. I expect longer-term rates to rise, but slowly. It's going to be fits and starts. It's going to be a long time to break out of this pattern or this holding pattern we've seen since April. But when they do, probably going to be big. Your thoughts, Ryan?
Yeah, I mean, agree. We're looking for higher rates too. Now, there have been a lot of people that have been talking about higher rates for years, and anything but that has happened. But yeah, I mean, I like to talk about copper. I don't know if you can pull up a chart of copper or not while I'm doing this. If not, it's okay. But copper has been really strong. Okay, so far the last several months. And copper, they call it like a Dr. Copper. So goes copper, goes the economy. He's got a PhD in the economy. I get it. China buys like half of the world's coppers, and China's coming back online. But it's very hard for us at LPL Research to be bearish the economy or bearish the global economy when copper is doing well. And when you think about it also, copper historically is kind of correlated with the 10-year yield, which is kind of where I'm going with this conversation now. If copper's been strong, we think the yields will eventually follow copper's lead here, and that'll push yields higher. So from that fixed income point of view, there's always a place for bonds in a portfolio, especially an uncertain world like we're living in now. But if you're going to have higher yields, the way we're looking at it here at LPL Research with the money that we run for our advisors, we're shortening up duration. Things won't be as impacted by a higher surge in yield prices. Also buying a little bit higher quality here. We do like mortgage-backed securities as a potential play on potentially higher yields going forward. And I do think copper is giving us that signal potentially on yields. Will probably be a good deal higher 6 to 12 months from now.
Yeah, good stuff. Well, I want to turn to the VIX. And if, guys, you could throw up the VIX curve at slide 6 here. Everybody's been talking about volatility. We've known for some time because we have VIX futures contracts that settle in every month, January through December. Those prices for October, November, December have been elevated for some time. And what this is showing is the VIX curve, and that's all these monthly forward dates that we're talking about. So basically the beginning of September versus October. So the cyan line that's higher in the beginning, that was September. And we can see there was priced in more volatility than we are currently pricing in right now. And this is versus what happened a month ago. But you can still see here that the VIX expectations going out are now more. So there's greater volatility than a month ago expected for the future. Ryan, how are you viewing volatility right now and your expectations for the next couple quarters?
Yeah, well, it makes sense, I think. I mean, there's just so much uncertainty out there. You're willing to pay up a little bit of a premium. Remember, the VIX is a function of option prices, and I traded options for about 11 years before I came in the world of money management, working with advisors like I do now. So I guess it kind of makes sense is the way to put it. And I hear the VIX, and it's like, known as the fear gauge, and I'm not crazy about that name on the VIX, but there's other ways to look at market sentiment. I mean, various sentiment polls, they're still showing investors are kind of skeptical, right? I mean, you look at fund flows. I mean, there's still not a lot of people jumping hand over foot, hand over fist, or whatever the saying is, to kind of get into equities here. And, that's from that contrarian point of view, maybe a bigger term picture positive. But at the same time, it just, let's be honest. Are we really going to have a president on November 4th? We probably will, but the chances of some type of an argument back and forth is very high. And what did we see in 2000 when we had to wait till I think it was December 12th until we got the official winner of the election? Well, we saw about a 10% correction in the S&P 500. So now that was also late 2000. That was a recession. There were different things happening. But with the uncertainty that is just swirling and kind of continues to swirl, again, just the last 24 hours, fiscal plan is off. Forget about it. We're just going to focus on the Supreme Court now. Oh, no, never mind. Here's $1,200 checks for people. That's not official, but it's just amazing at how quickly things change in this world we're in right now. And it's not really a laughing matter because it's unbelievable when you're talking real people's money. But at the same time, I think the market is willing to pay a little bit of a premium for any type of craziness that we're going to see either next month or so before the election or even a couple months after the election when anything is going to be very clear, I think, unfortunately.
Yeah, I'd have to agree with you there. I'm sure Mark Twain has a quote about that too somewhere.
What's Mark Twain? He said October is the most dangerous month for equities. The others are February, January, December, August, November. It's something along those lines. Mark's got them all. He's a good guy.
You can always safely attribute anything to him.
Yes.
All right. I want to play, since we're talking about potential surprises, volatility, I want to play a clip from Ian Bremmer, who was on one of our shows. This was a couple weeks ago, but he's highlighting some surprises, potential surprises that haven't happened. Let's take a listen.
What happens if there's a financial crisis involving emerging markets that are having a really hard time at a time when the president and the administration would need to agree on a major external bailout? That's a lot harder to do when we're fighting immensely over what just happened with the election. What happens if the Chinese government decides to change facts on the ground in Taiwan, or the Russians do in Belarus, or the Iranians do with the Straits of Hormuz, or the Turks do in the Eastern Med? In other words, I think that there's an exceptional period of risk, both domestically and globally, in those weeks to months when we don't actually know what the outcome of the election is going to be. And I think that there's real market volatility that can come around that. I mean, the story of the pandemic has been just how strong the American markets have been. Not clear to me we're going to feel that level of confidence when we're fighting over this election outcome, and we need clarity on what direction our government is actually headed.
Yeah, so I'm going to put up a chart of the EEM, Emerging Markets ETF by iShares, and we can see that we've been consolidating sideways since July. So this is basically at least 3 months, and maybe we're breaking out right now. It looks like RSI is only 60, so might have the momentum to do it. What are your thoughts, Ryan, on what Ian Bremmer just said and emerging markets here and potential risks?
Well, I'll just say this. That chair behind Ian looked really comfortable. I was like, why is he not sitting in that chair? But no, sorry. Here, at LPL Research, we like emerging markets. I mean, we're bullish. I can't disagree with anything he said. I mean, those worries and those concerns are absolutely there. Yet when you talk about emerging markets, a lot of it comes down to the U.S. dollar. In our view, the U.S. dollar is in a major structural shift where it's going to go lower. You look at the dollar for 16-year cycles, the dollar kind of makes major peaks, okay? In 85, the dollar made a major peak. In 2001, the dollar made a major peak. 16 years later is 2017. The dollar made a major peak, and I know we had that big spike in March when we were the dash for trash and never went to the dollar. But since then, it's obviously weakened. So if the dollar goes lower for the next 3 to 4 years, which is kind of our base case at LPL Research with lower rates and there's kind of some of the bigger structural concerns, all the deficits that we have, the dollar going down benefits global stock markets, specifically emerging markets. And again, I guess you still call China an emerging market, although I'm not so crazy about that, but you do. They're still a big part of it. China's growth is really coming back. I know nobody really trusts Chinese data. I get it, but I trust what Hyatt said. Hyatt said more people are staying in hotels now than they were back in September before everything really got bad, in China at least. So they're coming back online, and that is a big part of kind of why we like emerging markets. You talk about we like U.S. too, but where would a global investor go? We say emerging markets over developed international, specifically Europe there. We still like emerging markets. That's where the growth is coming from. There's good valuation. There's risk. There's always risk in emerging markets, no doubt about it. But with China really coming back, that's a risk we're willing to take in the portfolios that we run for our advisors.
And a weaker dollar generally good for risk markets in general.
Yeah.
We were just showing that. That slide that you put together that shows how U.S. dollar can predict the presidential outcome, and I think it's very much inversely kind of what we're seeing with, there we go, inversely what we're seeing with stocks. So we don't have to go over the details though, but weaker dollar, risk on, tends to predict the election in some way. Fair to say? All right.
No, exactly.
So go ahead.
Go ahead, sorry. I was just saying, if the dollar goes up a lot between now and the election, that doesn't bode well for President Trump. If the dollar weakens, that bodes well for President Trump. That's what history has told us when you follow the U.S. dollar and the currency markets, and it's kind of what it is. So pay attention to the currency market. And one thing along 2016, I was going to say this earlier, the Dow was down 9 days in a row directly ahead of the 2016 election. Copper, the industrial metal of copper, was up a record 14 straight days before that election in 2016. Everyone, including LPL Research, thought Hillary Clinton was going to win, not the stock market. Stock market's week ahead of the election. That tends to bode well for a new party or new power in the White House. And copper was an industrial play based for President Trump, right? Some type of infrastructure plan. It didn't really happen, but that was the play. So the markets were telling us a wildly different scenario than what every expert was telling us. And I'd rather pay attention to the markets, and that's why paying attention to the dollar and stocks and yields, all these different things might give a clue who's in the White House or who wins the election in November, but officially in the White House next January.
That's some great insight there. I want to go over the results from one of our previous polls, and this was the historically best quarter for stocks in any given year. Was it the first quarter? 14% said yes to that. Second quarter, 17%. Third, 7%. Fourth quarter, 62%. That is the right answer. Good job, guys. All right, so now our next poll here, let's see, poll 4. The top source for my trading decisions is free advisory service, paid advisory or subscription service, Twitter, message boards, financial media, my own research. We're going to go over the results for that in a second. Well, now I want to take a few minutes to go over Yahoo Finance Premium, and I just want to kind of overview what's available. We're going to take a look at kind of the value, diversification, risk level analysis that it provides, and then get into some concrete examples of how it selects trades or potential trades in various tickers here. All right, I'm just going to share my screen. We'll be up and running. All right, so this is what you'll see when you log in. This is the desktop, and I have a portfolio here. I created it arbitrarily just over a year ago. We can see it's outperforming the S&P 500, happens to be heavily loaded with FANG stocks, so actually outperforming by quite a nice margin. And it will give you fair value readings for your various constituents in there. It'll also give you what we have here on the left, research reports. These are fundamental reports by Argus Research. They will make buying, selling decisions, and company outlook. We have various fields here. This is unique. I will say I haven't seen this before. You can examine a company, for instance, like Netflix, on several different scenarios, just looking at this simple graph on dividends, innovation, hiring, sustainability, earnings. And then we have technical events for the short, medium, and long term. And we're going to take a look at a few stocks in a second here. But in general, we also have the insights. I find this particularly interesting and useful because if you click into, for instance, risk level, we're going to see this down here. You can get a measure of your entire portfolio. Is it over allocated to one area? And maybe that's what you want, but maybe you don't know, and maybe you should know. So we have portfolio risk measures that go historically, either monthly or more often, and also measures of volatility and beta of the portfolio to the market. That's how far it moves relative to a given move in a benchmark. So let's now check out a couple stocks, and what I want to do is go to our investment ideas. If you watch programs and you see me on a day-to-day basis, I do one of these usually every day. And we'll see if I can get this going here. Like my browser's a little slow. Okay, investment ideas. And so let's take a look at some of these ideas here. We can filter them by idea type, fundamental or technical. Take a look at one of each of them. How long-term, short, medium, long-term, what sector. You can have multiple portfolios here where you import your entire portfolio from your brokerage account. It's actually very, very simple. You can also do it by date range. So we'll just pull up Wayfair. This is an idea that was generated today, October 7th. They're boosting the target price to 360. They have a bunch of reasons here. You want to look at a chart, easy enough to do. You can see 22% potential if they do make that target. And here's what you would see in Wayfair. These are 1 month candles, but you can just see how they've been on an incredible tear since those March lows for the most part. Let's take a look at a technical position here, a recommendation. I think I was looking at one here. Baidu's always interesting. Take a look at Baidu. So we have a description of what it's doing. It has a bottoming triangle, bottoming wedge, and then they have a price target for it. So we view it in the chart. What I really like here is it shows you the pattern. So you can see here where the triangle exactly is, and you can see it's just barely budging to the upside here, but hasn't got off the ground just yet. It means there's still opportunity in the pattern. And if you wanted to set, for instance, some risk management price levels here, I would probably look under one of these moving averages. If you want to be ultra conservative, be below 118, that's a 200-day. But you could put it higher there theoretically too, maybe underneath this. So around, maybe 123, 122, something in there. Also on the right-hand side of the screen, it will tell you exactly what's going on, what the pattern means, event description. So kind of hold your hands there too. Pretty interesting. All right, so we're going to move on, and we're going to here's the results of our last poll. Top funding, top source for my trading decisions is free advisory service 5%, paid advisory 9%, Twitter message board 0%. Nobody falling into that trap. That's good. I like to hear that. Financial media 18%. My own research is the top vote getter. So that's impressive. It's always important to do your own research. I think you'd agree with that, Ryan, although you can rely on other people. But I just want to bring you back into this discussion and talk about sector performance again. I think we have some questions relating to that. So we talked about these rotation into value, cyclicals. There's a lot of talk about that. But what about hedging? Are there things people can do in maybe derivatives like stock options? Some people want to know if they should simply buy bonds. How do you hedge risk in this time? And we're only talking about the next few months until the election is sorted out, right?
Yeah, I mean, we'd probably say stay away from doing options unless you have, professionals potentially to help you. But the easiest way is maybe add a little more bonds. There's nothing wrong with using a little bit of cash also. And gold, we talked about that dollar going lower. Structurally, that should be a potential positive for gold. So, everybody in March when gold was getting killed, bonds were getting killed, stocks were getting killed, everything was getting killed. Everybody was wondering what to do, and a lot of people sold near the lows. And then you look back, it's like, man, if I just would have used that as an opportunity to kind of rebalance my portfolio and not panic, I might have had a really wonderful buying opportunity looking back. So it's so important to kind of have that, longer term. I mean, everybody becomes a trader on a pullback. Long-term investors become traders on pullbacks. And believe me, I know there's probably a lot of traders listening to this right now, but for those longer-term investors, it's just unique the way you need to use it. And just to that poll just for a second, if I could, with our advisors, what we've seen in 2020, right? Everything's been hyperdrive. The way technology, the way we communicate, everything's been hyperdrive. And what we found with our advisors, some of the most successful, and this is not just the world of financial advisors, just the world in general, are the most nimble, the ones that have their ability to adapt to the surroundings around them. Just the fact that we're doing this, virtually now, we didn't necessarily do as many of these things, and we're doing webinars all the time, WebEx and Blue Jeans and all these different ways to communicate. There's parts of the economy that are struggling. There's no doubt. You said 28,000 people at Disney just lost their jobs last couple of weeks. That is devastating. But at the same time, there are other parts of the economy that are really picking up, and whether it be financial services or any other area, it's the ones that are nimble and able to adapt that have really, really succeeded. And we've seen it with our advisors, we've seen it around the world, and there's going to be another recession. There's going to be more problems. Or can you adapt, and are you nimble? Are the two of the most important things you need to do to continue to be successful in our view.
Yeah, that's an excellent point, because nobody expected that we were going to descend into the fastest bear market in history, and almost nobody at the bottom thought we'd be reaching record highs within a few months. So being nimble, important, keeping your mind open, and also recognizing that these market cycles last many years on a secular time frame, maybe 10 years, but they change. We have brand new leadership this year. This reminds me, even in March and April, when the Fed first came out with the bazooka 10 emergency programs, that it reminded me of 2009, because we took off thanks to QE1 that year, which was really implemented in March, and the analog just in terms of the S&P 500 price right there. And I remember being in that environment in 2009 when names I'd never heard of, like Lululemon, I thought it was pronounced Lululemon because they didn't have any locations near me. But all these early leaders that ended up being later leaders, they were kind of born in that market cycle, and that's what we're seeing now. We're just seeing a repricing of a lot of that, the expectations for the new economy. And like it or not, we are in a new economy. But you mentioned jobs, Ryan. I want to get to a clip we have of Eric Rosengren. He's a New York Fed governor, and he's talking about the jobless situation. Let's take a listen.
I am very worried that we're pretty far away from what we think is maximum employment, and I think there are going to be significant headwinds to getting there quickly. So I have a somewhat more pessimistic forecast than my colleagues that you could have seen from the summary of economic projections that the FOMC recently put out. They're expecting that the unemployment rate will get below 6% by the end of next year. I'm not expecting that. And some of the headwinds include the problems with reemploying people. So I am worried that many of temporary layoffs are starting to turn to permanent as the pandemic drags on much longer than people expected earlier this year. So I think that's going to be a challenge, and particularly the segments of the labor market that are being impacted. So if you think about travel, if you think about tourism, if you think about restaurants, if you think about retail, those are areas where a lot of payroll employment increased over the course of the summer. But continued progress is really going to require that the pandemic be tamed to the degree that people can be fully employed, people feel comfortable once again going to restaurants and hotels.
Yeah, I think the bottom line for me is we have no idea what to expect. Things can change on a dime, and people People are going to get maybe more unemployment checks, but I think the big picture overall is there's going to be a restructuring, and we're going to be retraining. All right, before we go, I want to get to our next subject, which has to do with presidential health scares. That's something that happened recently. Probably not going to be a long-term impact here. It looks like President Trump is recovering out of Walter Reed Monday. But I do want to cover this. So our sixth poll, and we're going to get to this answer right here in this segment, is the most severe stock market reaction to a U.S. presidential health scare over the last century is it Warren G. Harding when he died, FDR when he died, Dwight D. Eisenhower heart attack, JFK assassinated, Ronald Reagan shot, Donald Trump COVID? And I went through the numbers here, Ryan. I went back through history, and it doesn't really look like much ever happens off of presidential health care. And that was kind of in line with what I thought, because these aren't structural risks to the economy. It's, unless somebody's a cult of personality here, like the leader of an authoritarian dictatorship, I wouldn't expect it to have much. But if we can put that slide up, we have it right here. You can just see the number of days to the bottom, usually one or two. We do have that exception with Dwight D. Eisenhower's heart attack, but aside from that, these tend to be one-off events. And I would say, I do want to cover this too, the potential, if something happens to President Trump between now and Inauguration Day, what happens, especially Election Day, because millions of people have already voted. It's hard to handicap this scenario. I think you'd have a lot of legal risk, probably a lot of wrangling in the courts, but I think we'd figure it out. And Ryan, I do want to get your thoughts on, what kind of surprises here we might see.
Yeah, well, it sounds like the Heisman, right? People vote for the Heisman before the season's over, and then some guy's a great game at the end. You're like, man, I should have voted for him. But, you think about it, when JFK was tragically shot and killed, you know what the S&P 500 did? It went up the next 8 straight months, one of the longest monthly win streaks that we've ever seen. I mean, so it's terrible what happened. But again, whoever wins this election is going to get the keys to a really solid economy, in our view, an improving economy. It's not rip roaring. I mean, the segment you just played from the Fed chairperson there, or Fed, who was it, Rosengren? From him, yep, talking about the jobs. I mean, I agree. Believe me, jobs are a big issue. I mean, they're not coming back as much as we would have thought. Yet, go look at consumer confidence, which just had one of its largest jumps ever, which historically speaking, end recessions. You've got housing, existing home sales, new home sales, 14-year highs. I mean, you can pick parts of the economy that aren't doing great, but there are some other parts that really are. And I want to summarize it with one more big picture thing called the 7-year itch. If you look back historically, there's a bull market, in my opinion, that started in 1950. 7 years in 1957, 20% correction, and a recession. You know what happened after that? Kept going up to 1966. 7 years in, had that bear market. My opinion, the bull market didn't start in 82. It started in 1980. That's when the S&P broke out to new highs for the first time in 1980. Do the math. 7 years later, that's 1987. Big time correction. And then what happened? Another 13 years of gains. Right now, this bull market, in my opinion, or the previous bull market, in my opinion, did not start in 2009. It started in 2013 when we broke out to new highs after a range of over a decade. You add 7 years to 2013, what do you get? 2020, just had a bear market, just had a recession. History would tell us potentially, if we follow those two other scenarios, there could still be years left of this major secular bull market with higher prices. And in my opinion, that's what I think is the case. People keep doubting this bull market. There are concerns, but this recession isn't like the other ones. This one stopped because we had to, because it's a devastating, virus that is impacting us. At the same time, the economy was in pretty good shape heading in. What's credit card debt done during this recession? It's gone down. We gave people money. They didn't just go out and spend it and waste it. Maybe some people did, but credit card debt's come down. So there are some positives that have taken place, and there aren't many. I mean, I know there's a lot of negatives, but bigger picture, the 7-year itch, whether it be relationships, your job, or the stock market, you get these corrections in 7 years, and then you can have years to go. And I just think that's something really important that a lot of people don't understand, and it made sense that 2020 had this correction. 34% in 6 weeks. I didn't think it'd be that fast, but some type of correction in 2020 made sense, and that's where we are so far, at least.
Yeah, all very good observations. And I would add, one thing you brought up was definition of bull market. There are several different ones. The financial media tends to use just one, which is the S&P 500, 20% correct or 20% downdraft on a close-to-close basis. We missed that by a fraction in 2011. I think in 2018 too. So a lot of it's arbitrary, but I like the way you look at the market. And I want to get to at least one more question before we have to end this here. How do you spot money flowing into a stock before it takes off? And I just want to pull up some charts here. And there are a couple different ways, not couple, there's dozens. Maybe there's an infinite number of ways. We're looking at DraftKings right here. And it was towards the beginning of the year. I think it was in January. This was a SPAC deal. So you actually had the opportunity to buy the SPAC before the deal was actually done. But just relationships with moving averages. I think that's one way of looking at it. When you have the price extended beyond it, you have a lot of money coming into it, and you have chart formations. That's another way of looking at it. So if you get to another high with, there are different ways of looking at this, but let's say you're retesting a high. There are certain technical indications that may say we can break out of this. I like to look at RSI as kind of a momentum indicator. You can use MACD, you can use CCI, lots of ways to look at this. Palantir, this is a really interesting stock. This just went live through a direct listing a few days ago, but for here I'm using anchored VWAP, and that's basically the volume weighted average price, and you can do it through an indicator, and this is free on our site, not even premium, under all indicators, anchored VWAP, and I have two lines on here. So this is measuring the average supply and demand. Are people making money? Are the longs making money? Are the shorts making money? If it's below, the shorts are making money. It's pretty interesting. And you can start this from different locations. So we got two now, from the very first bar, the 30-minute bars on Palantir, and then from the low. And you can see the price has started to use this lower anchored VWAP from this date right here, 10/6, the open. It's using it as support, and now it's breaking above. So it looks like Palantir is getting a little bullish to me, just based on this analysis. So there's lots to look at here, and I love trading, as I hope everybody can tell. And I think, Ryan, you're in the same camp. How do you look at the markets? And pick any ticker you want, and we can just take a look at it here before we go.
Well, I mean, yeah, I used to trade, like I said, more short term, looking at options. I'm now more of a bigger picture, macro thinker, and I agree with a lot of the things you just said. At the same time, I like to use relative strength. I mean, I mentioned, semiconductors earlier, like something like SMH. If you look at the semiconductor SMH versus the S&P 500, it's breaking out, right? Relative strength, it's outperforming more than it ever has the S&P 500. To me, those are the signs and the clues that we see when we're looking for big sectors or sector ETFs that potentially could start to do well. I mean, price action hasn't made a new high quite yet, but you've already got the breakout. And then you look at things like advanced decline lines, how many stocks going up versus down. Just 2 days ago, the S&P 500's advanced decline line made a new all-time high. People tell us how just a few stocks are leading this thing higher. Yeah, they're pulling it higher to a degree, but there's a lot more small caps out there that are starting to do better. There's a lot of beaten up names that are doing better. So that is participation. You see advanced decline lines peak anywhere between 10 to 14 months before the actual indices peak. We just made new highs on the S&P 500's advanced decline line 2 days ago. That would suggest, again, if we do this in 6 months or a year from now, we're probably going to have higher prices, because that's just kind of what history tells us. There is participation there. And with the credit markets and credit spreads still being low, there's two things I like to follow at the end of the day: advanced decline lines, and what do the credit spreads tell me? Advanced decline lines are strong, and the credit markets are still quite calm. Those are two reasons I think the fundamentals are still there and the technicals are still there. So this upward trajectory is still very, very much in play.
Yeah, I love looking at those advanced decline lines myself, and kind of a warning sign when we saw them getting into a short-term downtrend. Meanwhile, the market was still by its all-time highs. So I'm going to review the results of our last poll before we go here, and this was the most severe stock market reaction to a U.S. presidential health scare over the last century. And people guessed in the highest numbers, 41% for JFK, but the right answer was Dwight D. Eisenhower. That was a heart attack. 18%, though, did guess correctly. All right. I've been saying we're going to go pretty soon, and it's for real now. But I want to get to this one last viewer question. And this is by Elusis, what is one book you would recommend that is unrelated to trading, but help build the foundation to your trading? That's a good one. I'm going to answer first, because I saw that one coming. How to Win Friends and Influence People. That's one of those staples of kind of business management and personal growth seminars, whatever. But I think that kind of got me in a decent mindset to appreciate the psychological effects of trading, which are different than just about everything else, but it's a different approach. How about you, Ryan?
Yeah. I mean, I read just a lot of financial books. I'm trying to think. I mean, anything that Ben Carlson writes or Morgan Housel, I mean, those two are just some of the greatest financial minds. And they're not always writing about trading and what you should do with investments and things, but anything those guys do, kind of a new way, like, where do you get your information? Well, I get it from Twitter or something like that. There is absolutely, what those guys are doing. They've had some books come out recently. I would highly recommend anything those guys do, I think.
All right. And we're going to end on that note. I want to thank everybody for attending here. We do these once a month on the first Tuesday at 2 p.m. of every month. So we're going to be back here in November, and I'm sure we're going to be talking about the elections right around then. We'll have to see if we have a president. Nobody knows. Again, thank you, everybody, for attending. Thank you, Ryan, for being here and offering your wisdom. Lots of great stuff to take away from this. Thanks for all our support staff for their help. And we're going to end it right there.